So you're faced with this really fundamental question, right? How do you actually build wealth here in the U.S.? And you've got these major choices staring you down.
Yeah, it boils down to a few key paths.
Do you take the reins yourself? Do the DIY thing?
Or maybe lean on technology, some automation.
Right, like the Robo-Advisors.
Yeah.
Or do you go the traditional route, place your trust in a seasoned professional, a human advisor?
Which path is really the right one specifically for you? That's the million-dollar question, isn't it?
Exactly. And that's what this deep dive is all about. We're going to explore the pros, the cons, the key differences between these approaches. And we're basing this on a really interesting stack of sources you brought to the table.
That's right. We are diving deep into the world of personal investing in the U.S. And yeah, looking squarely at those three distinct ways: do it yourself or DIY, using a robo-advisor, or working directly with a human financial advisor.
And we've got a great mix of material here, which is cool. There's this unique personal perspective from someone who's apparently been a DIY investor for like decades. That's from Financial Samurai.
Yeah, really interesting story there.
And then we also have these detailed breakdowns, the nuts and bolts of advisor costs and the different types of advisors from trusted places like NerdWallet and Bankrate.
Plus, a pretty comprehensive look at that whole automated world of robo-advisors, drawing from Investopedia and some other sources for like cost comparisons and features.
Okay, so our mission today, what are we trying to do here?
Well, I think it's about distilling the most important nuggets, the key takeaways from all these different sources.
Right.
We want to give you, the listener, a really crystal clear picture of each path, help you understand which one might genuinely suit your specific financial situation, maybe your personality type, and definitely your long-term goals.
Yeah, it's not just listing features, is it? It's more about understanding the implications of choosing one way over another.
Exactly. What does it actually mean for you?
Okay, great. Let's unpack this then. And we're going to start by going deep into the world of DIY investing, drawing quite a bit from that personal account you mentioned from Financial Samurai.
Yeah, I like starting there because it's not just theory. It's grounded in someone's actual journey.
And it kicks off with this anecdote, right? This sort of spark that apparently ignited a lifelong passion for him.
It does. He talks about this moment, seems simple now, but was clearly profound for him. He saw his father trading stocks on a Charles Schwab online account, and this was way back in 1995.
Wow, that is early days for online brokerage.
Totally. And just seeing that visual, that kind of tangible connection to the market, it was enough to get him hooked. He asked his dad to teach him about it.
It really shows how just like early exposure can totally shape your financial habits down the line.
Definitely.
And that hands-on learning started early for him too, even with like not much money. He describes trading small amounts, maybe around $3,000 during his college years.
Yeah, which is classic, right? How a lot of people start. You have those early wins, maybe some losses, but with money that isn't, going to break the bank if you lose it.
Seems like a pretty low-stakes way to really learn the emotional roller coaster of investing.
Absolutely. That early experience with small sums, it probably built this really crucial foundation for managing risk, understanding volatility without, catastrophic consequences if things went wrong.
And that foundation clearly stuck with him.
It seems so. Even while working, get this, 13 years on Wall Street trading floors, like the absolute heart of the financial world, he was still doing his own personal DIY investing on the side. He just found it genuinely engaging, especially being right there, in the thick of it, feeling the market's pulse every single day. It wasn't just his job. It was a personal interest he was actively pursuing.
That's fascinating. You kind of think being on a trading floor would either make you only trust the pros or maybe just burn you out completely on finance.
Right. But for him, it seemed to fuel his personal DIY approach. But, and this is interesting, even with all that high-level finance experience, there was this pretty significant shift in his personal strategy over time.
Okay.
He mentions moving away from focusing just on picking individual stocks.
Which seems like what a trader would do.
Exactly. Towards a much broader focus on asset allocation, getting the mix right.
Why the change, though? Especially for someone with that kind of background. Seems counterintuitive.
Well, he explains that Even for someone really deep in the industry, consistently beating the market, like outperforming the broad indices just by picking individual stocks, it was simply too hard over the long haul. The sheer effort required versus the, inconsistent results just led him to rethink where he put his energy. It's a pretty powerful admission from someone who is in that world, really underlines how tough active stock picking is, even for pros.
And wasn't there like a specific incident that really drove this home for him? Something kind of weird.
Yeah, it's quite a story. He was apparently scolded by a lead managing director, not for losing money, but for trading too much volume in his personal account.
Seriously?
Yeah, something like $12 million in monthly trading volume.
Wow.
And that made him realize, okay, maybe this excessive trading, even if I'm just trying to capture small moves or stay active, maybe it's actually seen as a distraction or even like a career-limiting move within the structure of a big firm. Their priorities weren't necessarily about his maximizing personal trading gains.
Getting told off for being too active with your own money? That is...
Yeah.
Yeah, that's surprising. Really highlights the different goals, I guess, individual versus institutional.
It totally does. And it reinforced his pivot. He found that focusing on asset allocation, getting the right mix of stocks, bonds, maybe real estate, it made managing his own money way easier, less time consuming than constantly trying to pick the next winning stock.
Less about hitting daily home runs, more about building a solid foundation.
Exactly. A diversified portfolio for the long term.
So given his background, Wall Street, MBA, clearly an investing enthusiast, he felt hiring a financial advisor, at least initially, would just be a waste of money.
Which, yeah, on the surface, makes total sense. If you feel you've got the knowledge, the drive, why pay someone else, right?
Right.
But it's interesting. He does mention later having a free consultation, I think around age 35, after he'd retired early.
Oh.
And he says that session, even just a free one, it actually helped illuminate some blind spots he had. Biases or assumptions he still held from being a younger investor.
Huh. So even with all that knowledge...
Even then, he found some value in getting an objective outside perspective, even though he ultimately decided to stick with his core DIY approach mostly.
That's a really good point. It suggests that, yeah, DIY is powerful, but it doesn't mean you can't benefit from external input sometimes, maybe just a checkup.
Exactly. It's not always about a lack of knowledge. Sometimes it's just getting a different viewpoint or confirming your strategy, seeing things you might overlook when you're too deep in your own plan.
Okay. But the core argument for DIY, coming from this source anyway, is really compelling. It is genuinely easier and cheaper now than it has ever been, thanks to technology and how markets have evolved.
Oh, massively. The widespread availability of commission-free trading, all these accessible online platforms, incredibly low-cost index funds and ETFs, it's a completely different landscape than 1995.
For sure.
And the author sees empowering people to manage their own money as this key goal precisely because, look, if you avoid those ongoing advisor fees, you can potentially save a ton of money over decades.
Yeah, the compounding effect of fees is just brutal when you look at it over 30 or 40 years. Even seemingly small percentages add up to huge amounts.
Absolutely massive. And this is really crucial according to the source. DIY isn't just the default path for everyone. It takes specific characteristics.
Right. He outlines these 5 essential traits you need for successful DIY investing. Not just helpful, like prerequisites. First one is discipline.
Discipline is absolutely fundamental because as a DIYer, there's no one else making you do stuff, right?
Nope, it's all on you.
You have to consistently save a portion of your income, invest that cash flow regularly, maybe set up automatic transfers, and you need the discipline to, stay on top of your investments. Check in periodically, not obsessively, but regularly. Understand what you own. Make sure your capital stays properly allocated according to the plan you set.
And the source warns pretty clearly, right? Lack of discipline means you might miss contributions, or, maybe worse, your portfolio drifts way off target after market moves, and you don't rebalance.
Exactly. You end up way off track from your goals, potentially taking on way more or less risk than you intended.
Which ties right into the second trait he mentions, enthusiasm.
Yeah, you got to be genuinely interested in this stuff. Financial news, market movements, economic data, inflation reports, jobs numbers, government policies that might affect things, maybe even specific company performance if you're going to go beyond just broad index funds.
Because if you're not interested,
it becomes a chore. It feels like homework you keep putting off. And that's exactly when discipline starts to slide. If you're not enthusiastic about checking in or learning, you might let your asset allocation get totally out of whack after a big market swing.
Yeah, leaving you exposed to way more risk than you realized, or maybe causing you to panic sell at the worst possible time.
Precisely. And this enthusiasm, it often goes hand in hand with the next trait he talks about.
Ah, yes, hunger. Not just enthusiasm, but a real hunger for knowledge.
Right. And the source stresses you don't need a finance degree or an MBA. I mean, the author has one, but says it's not required, but you absolutely need this, like, insatiable thirst for knowledge about finance and investing.
That drive to keep reading, keep learning, keep trying to understand how things work.
Exactly. Believing there's always something new to learn, always a way to better understand opportunities or risks. It's about taking the initiative yourself, constantly.
Okay, number 4 is humility. This seems maybe one of the most critical, because as a DIY investor, you're operating without a net, basically.
Totally. And you will inevitably make mistakes. You will lose money at some point. Markets go down. Stocks you pick won't always work out. That's just reality.
Hard truth, but yeah, essential to accept. So humility is about recognizing you'll be wrong sometimes.
Accepting those losses gracefully.
And being willing to learn from them.
Yeah.
Right. Make adjustments without letting your ego get in the way.
Yes. And crucially, the source emphasizes staying humble, especially during the good times, during those roaring bull markets.
Yeah. When it's easy to think you're a genius.
Exactly. It's so easy to confuse the market's rising tide, just lifting all boats with your own personal brilliance, losing that humility. It leads to overconfidence, taking on way too much risk, maybe abandoning diversification, trying to time the market perfectly, often right before things turn sour.
Being self-aware, knowing when your emotions are driving decisions, seems huge.
Absolutely massive for successful DIY, knowing when you're just riding a wave versus actually steering the ship effectively.
Okay, and the final trait, optimism.
Yeah. To take the risks that investing inherently involves, you need this sort of general belief that over the long term, things will probably work out okay. Economies will grow, companies will innovate, progress will happen.
Investing is fundamentally an act of faith in the future, isn't it?
It really is. You're putting money at risk today, hoping for a greater return tomorrow. If you lack that underlying optimism, it can paralyze you. You might just hoard cash indefinitely, avoid opportunities like the stock market or buying property, just be too fearful to act.
So the successful DIYer, in this view, believes they can get results just as good as, maybe even better than, the pros or the robos, fueled by their own effort and that belief in the long-term system.
That's the idea.
So if you look inside and feel like, yeah, I've got those 5 traits, discipline, enthusiasm, hunger, humility, optimism, then DIY could be a really rewarding path.
But even with those traits, just the sheer number of investment options out there can feel totally overwhelming when you first start.
Oh, for sure. Thousands of stocks, bonds, funds, commodities, crypto. Where do you even begin?
Right. But the source suggests that focusing on that core principle asset allocation really helps narrow the choices, makes the task manageable. You don't need to be an expert in every single thing.
Okay, so the recommendation from most DIY folks is to focus on building a diversified portfolio, using just a handful of really low-cost, broad market things.
Typically, yeah. Low-cost ETFs, exchange-traded funds, and index funds. Maybe adding some REITs, real estate investment trusts, if you want some real estate exposure without buying physical property directly.
And the source lists some common examples, right? Like the bedrock stuff. STY, IVV, VOO, VPI for tracking the S&P 500 or the whole U.S. stock market.
QQQ for the tech-heavy NASDAQ.
IEF or TLT for treasury bonds at different lengths.
MUB for municipal bonds, which can have tax advantages.
And then a bunch of tickers for big REITs in different sectors like VNQ, IYR, AMT, SPG, PSA, EQR, DRL, stuff like that.
And the argument is, look, for the vast majority of people, maybe 80% or even more, building a portfolio just from that relatively short list of low-cost, super diversified ETFs, that should be totally sufficient to get market returns and meet long-term goals.
You don't need crazy complexity to get effective diversification.
Not at all. Keep it simple.
And the source gives a really simple, tangible example of how you might start, say, a 30-year-old investor. Maybe they go with 70% stocks, 30% bonds.
Right. And you could easily do that just by putting 70% of your money into, say, a total stock market ETF like VTI or an S&P 500 one like SPY and the other 30% into a bond ETF like IEF. Boom. Done. Simple starting point.
But investing isn't static, right? Because life isn't static. Your strategy, your allocation, it might need to change based on big life events.
Totally. The example given is, okay, that same investor hits age 35, decides they want to buy a house, needs a big down payment.
Right.
They might strategically sell some or all of that bond portion, which is usually less volatile than stocks, to fund that purchase. And obviously that changes their allocation. So your DIY strategy has to be adaptable to your life, not just reacting to the market day to day.
Makes sense. The source also gets into that classic debate within DIY, active versus passive allocation.
Yeah. The dream of beating the market.
Right. While you can try to outperform by picking individual stocks or maybe actively managed funds, the stats over decades are pretty brutal. Most professional active managers actually fail to beat their benchmark index over the long run, especially after you account for their higher fees.
And hey, if the pros struggle, the odds are even tougher for the average DIY investor, right?
You'd think so.
Yeah.
Yet that allure of hitting a big winner, finding the next Amazon or whatever, it's powerful.
It is. But the source gives some practical advice here. It says, okay, maybe finance pros might allocate up to 50% to active strategies if they really know their stuff. But for the typical DIY enthusiast who still wants to try their hand, maybe pick a few stocks or sector funds they believe in. Yeah.
He recommends allocating no more than 20% of your total portfolio to those active or individual positions.
Okay, why that 20% limit specifically?
The thinking is it's meaningful enough that if those active bets do pay off big, they can actually make a noticeable difference in your overall return, give you a little boost. But crucially, if that 20% goes sideways, which is always a risk with active picks, it's not so large that it's going to completely wreck your entire financial future or undo all the good work from the other 80% in your diversified passive stuff.
So it limits the potential damage.
Exactly. Though, as the source points out, it does depend a lot on what's in that 20%. Investing 20% in one super speculative penny stock is way different risk-wise than putting 20% into, say, 5 different large established blue chip companies.
Good point. Nuance matters.
This whole discussion kind of leads into an interesting debate the author mentions seeing in the comments on his article.
Yeah.
What actually makes someone a great investor?
Is it just about consistently beating the market indices year after year? Or is just being a responsible investor someone who performs pretty much in line with the market? Is that actually a form of greatness now? Especially given how easy it is to get those market returns with low-cost passive tools.
What's the author's take?
His personal view seems to lean towards needing to outperform to be truly great in that traditional sense. If everyone's just matching the S&P 500, you're only getting relatively richer compared to inflation or cash, but maybe not pulling ahead of your peers who are doing the same thing with index funds.
Okay.
But he also says he's personally happy being a good or average investor by focusing on smart capital allocation, building wealth across different asset classes rather than just chasing those elusive market-beating stock returns constantly.
So it kind of highlights that even within DIY, people can define success differently. Depends on your goals, your risk tolerance.
Totally. And even if you have the right traits, you focus on asset allocation, there are still inherent risks, right? Caution specific to the DIY path. The author's pretty candid about his own mistakes over the years. He admits losing money, buying or selling at the wrong times, classic emotional mistakes, trying to time the market.
Been there. Yeah. He also mentioned investing too much in individual stocks or sectors that just didn't pan out, violating that diversification rule.
Yep. And a big challenge, he notes, is just navigating those massive market meltdowns, like the super sharp, fast downturn in March 2020 when the pandemic hit.
Oh, yeah, that was rough.
The source suggests that the great DIY investors, or maybe just the really disciplined ones, they're the ones who shine during those periods. Yeah. Not necessarily by perfectly timing the bottom,
but by staying disciplined, sticking to the plan.
Exactly. Avoiding panic selling, maybe even having the conviction and the discipline to actually buy more when everyone else is freaking out.
Easier said than done, though.
Way easier said than done.
Yeah.
There's this memorable quote he references, apparently from an old job interview. Classic Wall Street wisdom. Bulls make money. Bears make money. Pigs get slaughtered. I've heard that one. And he relates it right back to that need for humility for the DIYer. Specifically, the danger of getting too greedy, too overconfident during a long bull run.
Confusing the market, lifting you up with your own genius again.
Precisely. Overconfidence makes you a pig, and you risk getting slaughtered when the inevitable downturn hits. Keep that ego in check.
Okay, so beyond stocks and bonds in the public markets, the author talks a lot about real estate as a key part of his personal DIY strategy.
Yeah, a big chunk. He holds about 50% of his overall net worth in real estate, apparently, split between actual physical properties and some online real estate investments.
Why is such a heavy weighting? What's the appeal for him?
He explains his preference. One, it's tangible, right? You can see it, touch it. Two, historically, it's often been less volatile day to day than the stock market. Three, it provides utility like shelter. And four, it generates income through rent.
Which he contrasts with stocks, right?
Yeah.
Which typically have lower dividend yields and more price swings.
Exactly. It aligns really well with his big goal of building passive income streams.
And he gives concrete examples, which is helpful. He mentions holding around $973,000 in private real estate investments, specifically located in the U.S. heartland.
Right. And his reason for choosing those markets, away from the super expensive coastal cities like San Francisco, where he used to live, was partly diversification, geographically speaking.
Makes sense.
And potentially finding higher rental yields compared to the purchase price, investing in areas with different economic drivers. These are specifically income-focused properties for him.
And he also talks about these online platforms that let people invest in real estate, even if they don't want to or can't buy physical buildings themselves.
Yeah, two main ones he mentions. Fundrise is highlighted as being really accessible. It's open to both accredited and non-accredited investors, which is key.
So pretty much anyone can use it.
Pretty much. It offers exposure through these diversified funds that pool everyone's money together. And they strategically focus on what he calls Sunbelt and Heartland markets areas, often seen as having maybe lower valuations, potentially higher growth or yield prospects compared to the big coastal hubs.
And Fundrise has been around a while.
Since 2012, apparently. Manages over $3 billion in assets, has nearly 400,000 investors, and get this, a minimum investment of just $10.
$10. Wow, that is accessible.
Super accessible. And he mentions he personally has a significant chunk invested in Fundrise, over $290,000, as part of his passive income strategy.
Okay. And the other platform you mentioned?
That was CrowdStreet. This one's generally for accredited investors, people who meet certain income or net worth requirements.
Gotcha.
CrowdStreet offers investments in individual real estate deals. So you can actually choose specific properties or development projects you want to back rather than just a diversified fund.
More targeted.
More targeted. And he notes they often focus on opportunities in 18-hour cities.
What?
They're like secondary cities, not the 2047 global hubs like New York or LA, but places with strong economies, job growth, good demographic trends, often with lower property values than the prime markets. Think Austin, Nashville, Denver, maybe a few years ago.
Okay, interesting niche. So his overall real estate chunk, physical and online, it contributes a lot to his passive income goal.
Hugely. He's aiming for $300,000 total passive income a year and wants about half of that, 50%. To come from these real estate investments.
Wow. Okay. So it really shows that DIY doesn't have to mean just stocks and bonds. It can include other asset classes like real estate.
Absolutely.
Yeah.
But success still relies on applying those same core principles: discipline, research that hunger for knowledge, and managing your risk appropriately.
And he also recommends using tools to help, right? Like free financial tracking tools. He mentioned Empower, which used to be Personal Capital.
Yeah, he shares this really good practical story about using their investment checkup feature on an old 401k he had from a previous job. The tool analyzed his holdings in that old account and flagged one fund he owned that had a pretty high expense ratio, like 0.74% a year, a cost he just hadn't been paying close attention to in that forgotten account. But by simply swapping that expensive fund for a similar broad market index fund with a much lower fee that was available within that same 401k plan, he figured he'd save around $700 a year, just in fees. On that one holding.
$700 a year. That perfectly shows the practical benefit of DIY and using those tracking tools, doesn't it? Actively finding and cutting costs.
Totally. That 0.74% might sound small, but $700 a year compounded over many, many years, that's a significant chunk of money saved. And that saving goes directly into your pocket as higher net returns.
Okay, so let's wrap up this deep dive into the DIY approach. Based on these sources, who is this really best for?
Well, it seems best suited for someone who is genuinely willing and able to dedicate the necessary time and effort. You got to put the work in, learn the stuff, manage it.
And crucially, possess those 5 essential traits we talked about: discipline, enthusiasm, hunger, humility, and optimism.
Absolutely. So this path is probably ideal for folks who want maximum control over their investments, who are aiming for the absolute lowest potential fees by cutting out the middleman, and who actually enjoy the process, researching, understanding, managing their own money. It's kind of like being your own personal finance CEO.
Okay. Moving on from that full control world of DIY, let's look at the automated middle ground that's really exploded over the last decade or so. Robo-Advisors.
Right. Drawing insights now from places like Investopedia, Bankrate, NerdWallet. This approach is often pitched as the ultimate in do-it-for-me investing, especially for a broad audience.
So fundamentally, what are they?
They're investment services that rely almost entirely on computer algorithms and software to manage client portfolios.
So instead of a human making the day-to-day calls.
A pre-programmed system does it. Buys, sells, rebalances, all based on code.
How does it work for the user, though? How do you get started?
It's designed to be really simple, very accessible. You open an account, usually online or through an app, and you start by answering a series of questions. Typical stuff. What are your financial goals? Retirement, buying a house, just saving. What's your investment time frame? When do you need the money back? How comfortable are you with risk? Can you stomach market swings? And how much money do you have to invest now? And how much can you add regularly?
Okay, so you feed it your basic info.
Exactly. And the core function is that the algorithm takes that info, basically, your investor profile, and uses it to automatically build and then manage a diversified investment portfolio for you.
And what's usually in that portfolio?
Typically, it's built using a mix of low-cost ETFs and index funds. The specific mix is chosen to align with the risk tolerance and goals you told it about.
And critically, these systems, they're designed to automatically implement good, standard investment practices, right?
Yes, exactly. Things like setting up an appropriate asset allocation based on your profile. So maybe more stocks if you're young with a long time horizon, more bonds if you're older and closer to needing the money.
Making sure you're diversified.
Right. Spreading your money across different asset classes, different parts of the world, all through those ETFs. You don't have to manually pick the funds or figure out how much of each to buy. The system just handles it.
Okay, let's break down the pros. What are the big advantages of using a robo-advisor, according to the sources? First one that always comes up is cost.
Yeah, they are definitely cheap compared to most traditional human advisors who charge based on assets. The sources consistently mention low assets under management, or AUM, fees for robos, usually in the range of 0.25% to maybe 0.50% per year.
Okay, put that in real numbers. What does that mean?
So let's say you have a $50,000 account. A 0.25% fee is just $125 a year. A 0.50% fee is $250 a year. That's the fee you pay to the Robo platform for their service.
And it's important for people to get this, that Robo fee is on top of the fees charged by the ETFs themselves, right? The underlying fund fees.
Correct. But since Robos typically use very, very low-cost ETFs anyway, those underlying fees are usually tiny, maybe 0.05% to 0.35% annually, in that range.
So your total all-in cost might be somewhere around, what, 0.3% to maybe 0.6% a year, combining the robo fee and the fund fees.
Yeah, that's a reasonable estimate, which is significantly lower and usually much more transparent, especially for people with smaller or medium-sized accounts compared to what many traditional human advisors charge.
Okay. What's another big pro?
How easy they are to open and use. The whole process is streamlined online. You can often go from zero to having a fully managed, diversified portfolio in like 15 or 30 minutes.
Wow.
Just provide some personal details, answer those questions, link a bank account, and you're basically good to go. And they support all the common account types: taxable brokerage, Roth IRAs, traditional IRAs, SEP IRAs, joint accounts. So they work for lots of different needs.
That accessibility, just lowering the barrier to entry, that seems huge, especially for new investors or maybe people just intimidated by the whole traditional finance world.
Totally. And related to that is low or no account minimums.
Right. You don't need a fortune to start.
Exactly. While some might ask for $500 or $1,000, a lot of the big ones have absolutely no minimum balance requirement at all.
Which means you can start investing with whatever you have, right? Even if it's just $50 a month, you can start building wealth immediately instead of waiting until you've saved up some big lump sum.
Precisely. It democratizes access to professionally managed investing.
Okay, and the final big pro, the automated services themselves.
Yeah, this is a key part of the value proposition. Robo-advisors are programmed to handle these crucial, but often kind of tedious investment tasks automatically.
Like rebalancing.
Exactly. Automatically rebalancing your portfolio periodically. So as markets move and some parts grow faster than others, the system automatically buys and sells to bring you back to your target asset allocation, keeps your risk level consistent.
Which is something a lot of DIY investors maybe forget or neglect to do.
Easily done. And robos can also do more sophisticated stuff that's actually pretty hard for humans to do efficiently, especially for smaller accounts, like daily tax loss harvesting in your taxable accounts.
Explain that again quickly.
Sure. It involves automatically selling investments that have gone down in value, just enough to realize a loss that you can use to offset taxable gains elsewhere, potentially lowering your tax bill. Then it immediately reinvests that money into a similar but not identical investment to keep you diversified and invested in the market.
Ah, okay. Trying to eke out some tax savings automatically.
Right. And doing that daily, that level of constant monitoring and precise execution for tax efficiency is really hard for a human advisor to replicate cost effectively, especially if you don't have a huge account.
Okay, so robos definitely take the friction and the manual labor out of basic portfolio management. But obviously there are downsides. The sources point out some important cons too. The biggest one seems to be the fundamental lack of human touch.
Precisely. You're dealing with a computer program, not a person. You don't get that individualized guidance. You don't get the empathetic ear when the market tanks and you're feeling nervous.
Yeah, no one to talk you off the ledge.
Right. Or the ability to have a really nuanced back and forth conversation about complex life stuff or unique concerns that might affect your finances. The service is scalable and efficient because it strips out that bespoke human interaction for every client.
Which leads right into the next con, limited personalization.
Yep. While the algorithm does tailor the portfolio based on your answers, those questions are pretty generic, right? And the resulting portfolio is based on broad models, not a deep dive into your specific unique life.
So if you have something complex or uncommon,
it struggles.
Yeah.
Or just can't handle it. If you have a really tricky tax situation, maybe you need advice on employee stock options, you're planning long-term for a child with special needs, or you have complicated estate planning goals. A standard robo-advisor just isn't equipped for that level of nuance or integrated advice.
Their personalization is algorithmic, not actually personal.
Well put.
Okay, another point. While they're cheaper than human advisors, they can still be potentially higher cost than pure DIY.
That's true. As we discussed in the DIY section, if you're willing to do the work yourself, open a brokerage account, buy the exact same low-cost ETFs the robo would use.
Your only cost is the tiny expense ratios of those funds themselves.
Right. You'd save that 0.25% to 0.50% AUM fee that the robo charges on top.
But that saving comes at the cost of your time and effort and needing those DIY traits we talked about.
Exactly. The robo fee is basically paying for the automation, the convenience, the rebalancing, maybe the tax loss harvesting, that whole set it and forget it aspect. So it's a trade-off, time and effort versus that extra fee.
Gotcha. What about limited investment options?
Yeah, robos typically stick to a core menu of widely available, highly liquid ETFs and index funds covering the major asset classes. Stocks, bonds, maybe a little international, maybe a little real estate via REIT ETFs.
Which means you usually can't use them to invest in, say, individual stocks you like, or individual bonds.
Generally, no. Or alternative assets, like those specific private real estate deals or crowdfunding platforms we talked about with DIY. If your strategy involves those less common things, a robo probably won't support it, or you'd have to manage those investments completely separately.
Okay. And the last con mentioned is maybe a lack of flexibility or human judgment.
Right. Because they run on pre-programmed algorithms, robos might not react quickly or strategically to truly unprecedented market events or sudden shifts in the economy in the way a human advisor might. Now, that human judgment isn't always better. Humans panic too.
Sure.
But robos just stick to their models, which prevents emotional mistakes. But it also means they won't deviate from the plan, even if a human looking at the big picture might think, maybe a temporary tactical shift makes sense right now. They lack that adaptability.
Okay. So summing up the robo-advisor path based on the sources, who are they best for?
Seems like they're a really good fit for new investors just getting started. Also for people who just prefer a simple, automated, set it and forget it approach.
People who want that instant diversification without the manual work or without the much higher cost of many traditional human advisors.
Exactly. And whose financial needs are relatively simple and straightforward. Things that fit neatly within the parameters of what an algorithm can handle effectively. They really have made professionally managed, diversified portfolios accessible to almost everyone.
Okay, great overview. Now, let's pivot to the third path, working with a human financial advisor.
Right.
The sources, like NerdWallet, Smart Asset, Bankrate, they really emphasize that hiring a human is often about way more than just managing investments. It's frequently about comprehensive financial planning.
Yeah, the scope is potentially much, much broader compared to a robo or even what most DIYers handle themselves.
They offer a wider range of services.
Absolutely. Human advisors can tackle this whole spectrum of financial needs. It can range from basic stuff like budgeting help or banking advice, all the way up to really complex areas, like designing and implementing intricate estate plans, setting up and managing different types of trusts, reviewing your insurance coverage to make sure it's adequate, providing specialized tax planning advice that actually integrates with your investment strategy. They're meant to look at your entire financial picture holistically.
So this comprehensive view means they really shine when dealing with complex, maybe unusual or very specific financial situations. Things that need nuanced expertise, maybe some human empathy, personalized attention.
Things an algorithm just can't do, exactly. And things that might be overwhelming or require specialized knowledge that a typical DIY investor might not have. Think about coordinating advice between your accountant, your lawyer, and your investment strategy. A good advisor can quarterback that.
Okay, let's get into the weeds on cost structures and typical fees for human advisors. This is where things get more varied and potentially much more expensive compared to DIY or robos.
Yeah, this reflects the breadth and the personalization of the services they can offer. Lots of different ways they get paid.
The most common model, especially for traditional wealth management firms, seems to be assets under management, or AUM.
Yes, the sources consistently cite typical AUM fees for human advisors somewhere in the range of 1% to 2% annually. Sometimes tiered, so the percentage drops on larger amounts, but that's the general ballpark.
And that's a percentage of the total value of the investments they're managing for you, right?
Correct. So simple math. On a $100,000 portfolio, a 1% AUM fee is $1,000 a year you pay the advisor. A 2% fee is $2,000 a year.
And it's crucial to compare that to the robo range we just talked about, like 0.25% to 0.50%.
Huge difference. And think about how it scales. On a $1 million portfolio, that 1% fee is $10,000 a year. On $5 million, it's $50,000 a year, every year.
Wow. The dollar amount of the fee grows directly with your assets, even if the actual complexity of managing those assets doesn't necessarily grow at the same rate.
Exactly. It's a fee model that really benefits advisors who work with high net worth clients. That difference in cost versus a robo or DIY can become incredibly significant over your investing lifetime, especially as your wealth grows.
Okay, what's another model? A flat annual or monthly fee, sometimes called a retainer.
Right. This is a fixed dollar amount, not tied to how much money you have invested with them. It's a set fee for ongoing planning and advice services.
Does the fee change?
Well, the annual amount might go up if your situation gets way more complex, but generally it's agreed upon upfront. The sources suggest these retainer fees can range pretty widely. Maybe $2,000 to $7,500 annually seems typical. One source gave an average of around $4,500 a year, or like $215 a month.
This model could actually be more cost-effective than AUM if you have a really high net worth, right? Because the fee stops going up even if your assets keep growing.
Potentially, yes. It decouples the fee from the asset size.
Then there's the hourly rate model, pay as you go.
Yep. Just like hiring a lawyer or an accountant, you pay the advisor only for the specific time you use their services.
What are typical hourly rates?
Sources say usually between $200 and $400 an hour, with an average maybe around $270 per hour.
This seems like a really good way to get expert help for specific, one-off things, right? Without committing to an ongoing relationship or paying based on assets.
Totally. Maybe you just need someone to review your estate plan draft, or give you advice on rolling over an old 401k, or analyze how buying a rental property might impact your overall finances. Pay for a few hours, get the advice, and you're done. Very cost-effective for targeted help.
Some advisors also work on a per-plan fee basis.
Yes. This is a set one-time fee just for creating a comprehensive financial plan document for you, like a big roadmap.
How much does that usually cost?
Typically between $1,000 and $3,000 according to the sources, with an average maybe around $2,500. You get this detailed plan with recommendations for investments, savings, insurance, all that stuff.
But that fee usually doesn't include them actually managing the money or giving ongoing advice, right?
Generally not. It's best if you're comfortable getting the plan and then either implementing and monitoring it yourself, like DIY, or maybe using a Robo-Advisor or another service to execute it.
Okay. And finally, the commission model. This one sounds potentially problematic.
It can be. Here, the advisor gets paid directly by the company whose financial product they sell to you.
And crucially, those commissions are essentially coming out of your pocket, right? Embedded in the product costs.
Yes, indirectly. You see this commonly with mutual funds that have loads of sales charges that can be 3% to 6% or even more of your investment, paid upfront or over time, or sometimes through fees tied to annuities or certain insurance products.
And the sources warn pretty strongly against commission-based advisors if you're looking for unbiased advice.
They do. Extreme caution is advised, often outright avoidance, because the advisor operating purely on commission has a direct financial incentive to recommend the product that pays them the highest commission,
rather than necessarily the investment that is truly best for your specific situation and goals.
Exactly. They might only be legally required to recommend investments that are deemed suitable for you, which is a significantly lower standard than acting in your absolute best interest.
Which brings us perfectly to probably one of the most critical concepts when you're choosing a human advisor: the importance of fiduciary duty. What exactly does that mean for an advisor to be a fiduciary?
At its core, it means they are legally bound, legally obligated to act solely in your best interest at all times regarding the advice they give.
They have to put your financial well-being, your needs, ahead of their own compensation or any other competing incentives.
Yes, it includes obligations for transparency, acting in good faith, and proactively minimizing or, at the very least, fully disclosing any potential conflicts of interest they might have.
Why does this matter so much to me, the investor?
Well, fundamentally, it provides this huge layer of trust and peace of mind. Knowing your advisor is legally required to prioritize you means you're far more likely to get recommendations truly tailored to your situation, not skewed by how they get paid.
They have to seek the best prices and terms for you too, right?
They do, and fiduciaries tend to be more transparent. They should explain their decisions, provide the relevant facts, help you understand the why behind the advice.
And practically speaking, if something goes wrong.
If a fiduciary advisor breaches that duty and actually causes you financial harm, you generally have clearer and stronger legal recourse than you might with a non-fiduciary advisor who only had to meet that lower suitability standard.
Okay, so it's a big deal. Given how important it is, how can you actually verify if an advisor operates as a true fiduciary? How do you check?
A key method the sources highlight is to work with a firm that is registered with the SEC, the Securities and Exchange Commission, or your state's securities regulator as a registered investment advisor, or RIA.
All right.
Firms registered as RIAs are legally required to act as fiduciaries for their clients at all times when providing investment advice. That's a clear legal distinction.
And the sources make a point about broker-dealers, right? They have a different standard.
Yeah, it's important. Broker-dealers are now subject to a standard called Regulation Best Interest, which is more stringent than the old suitability standard, but it's not the same comprehensive, legally defined fiduciary duty that RIAs have. It's a subtle but important difference.
What about looking for specific professional certifications? Does that help?
It can be a helpful indicator. While the certification itself might not automatically create the legal fiduciary duty that's mainly tied to the RIA registration certifications like CFP, which stands for Certified Financial Planner, often signal a strong commitment to high ethical standards, which includes acting in the client's best interest.
So it's a good sign, but maybe not a legal guarantee like the RIA status.
Generally, that's a fair way to put it.
The sources also recommend using some publicly available search tools.
Yes, organizations like NAPFA, the National Association of Personal Financial Advisors, whose members are specifically fee-only fiduciaries.
Fee-only, meaning they only get paid directly by the client, no commissions.
Correct. Also, the CFP board website lets you verify if someone holds the CFP mark, and NENRA, the Financial Industry Regulatory Authority, has tools mainly for checking the background and disciplinary history of broker-dealers and their registered representatives.
But just searching online isn't enough, right? You need to talk to them.
Oh, absolutely. The sources strongly advise doing initial consultations with potential advisors and asking really pointed questions about how they run their business and, crucially, how they get paid.
What are the key questions to ask?
Definitely. How are you compensated? Listen carefully for fee-only versus fee-based. Fee-based sounds similar but is very different. It means they can charge fees and also earn commissions, which introduces conflicts. Ask, what specific certifications and licenses do you hold? What range of services do you offer beyond just investments? Who is your typical client? Do they look like me? How will we communicate and how often? And here's a big one. Are you willing to provide a written commitment stating you will act as a fiduciary for me?
Getting it in writing adds clarity.
Definitely.
You should also ask for and review their official disclosure documents, Form ADV and Form CRS.
Yes. These are documents advisory firms must file with regulators. Form ADV Part 2 is often called the firm brochure, and Form CRS is a shorter customer relationship summary. They are publicly available online through the SEC's IAPD tool Investment Advisor Public Disclosure.
And these docs contain
Essential info. Their business practices, exactly how they charge fees, the qualifications of their team, any potential conflicts of interest they have, and importantly, any disciplinary history. Reading them might feel like homework, but it's absolutely vital due diligence.
Okay. The sources also give examples of what a breach of fiduciary duty actually looks like in the real world.
Yeah, it helps make it concrete. Examples include things like account churning, making tons of unnecessary trades just to generate commissions in commission-based accounts, misrepresentation, lying about the risks or features of an investment, making trades in your account without your permission, unauthorized trading, failing to disclose conflicts of interest, like recommending a mutual fund, mainly because it pays the advisor a higher kickback.
Self-dealing, too. Using client money for their own benefit.
Yep, that's a major breach. Also, failing to adequately monitor your accounts or simply failing to follow reasonable instructions you gave them. Knowing these red flags helps you spot potential problems.
Okay, so let's sum up the human financial advisor path based on the sources. Who is this generally best suited for?
It seems best for individuals whose financial situations are complex, going well beyond just basic investment management. People with higher net worth, where the cost of advice might feel relatively more acceptable, or they simply need more sophisticated tax, estate, or investment strategies.
Also, individuals who really need or strongly prefer that personalized guidance and the human relationship aspect.
Right, and those who need help with very specialized financial tasks, intricate tax planning, setting up trusts, business succession planning, things like that.
And the absolute critical takeaway is, choosing an advisor requires careful due diligence. You have to do your homework. And prioritizing finding a true fiduciary, someone legally bound to act in your best interest, is absolutely paramount.
Couldn't agree more.
Okay, so we've explored each of these three distinct paths in detail, taking full control with DIY.
Leveraging automation with a robo-advisor.
And seeking that comprehensive guidance from a human advisor. Let's try to compare them directly now. Think about how you, the listener, might choose your American investment path.
Yeah, let's recap those core trade-offs across the key categories we've hit on. First up, let's revisit cost.
Okay. Generally, DIY looks like the cheapest option in terms of direct fees paid to others, right? But the cost is your own time and effort, which isn't insignificant.
Exactly. Robos sit in that low-cost middle ground, automated management, much cheaper than most traditional humans.
And human advisors. Most varied cost, potentially the highest, especially with those AUM fees on large accounts. But that higher potential cost comes with potentially broader, more personalized, comprehensive services for complex needs.
Right. Now, think about control and involvement.
DIY is max control, max involvement. It's all you.
Robo-advisors are low involvement. You delegate the investment management control entirely to the algorithm based on your initial setup.
And with a human advisor, you delegate the day-to-day investment control. But you're still, hopefully, highly involved in the overall financial planning and strategy setting.
Good distinction. What about the actual services offered?
DIY is primarily investment selection and management done by you. Though, as we saw, you can expand that to real estate or other things if you put in the work.
Robos provide that automated portfolio construction, management, rebalancing, maybe tax loss harvesting, all driven by your profile and the algorithm, focused mainly on the investing part.
And humans offer the widest potential range. Comprehensive planning covering budgeting, taxes, estate, insurance, investments, retirement, integrating it all.
Okay, how about the human touch and personalization factor?
Huge variation here. DIY, basically zero external human touch. You're on your own.
Robos, minimal to none in the core investment management anyway. It's algorithm driven. Some hybrid models are emerging with limited human access, but the core is automated.
And human advisors. That's where you get the high degree of personalized attention, tailored advice, maybe emotional support during tough markets, that direct human relationship.
Makes sense. Finally, let's consider the requirements or prerequisites for each path.
For DIY, you need those 5 traits: discipline, enthusiasm, hunger, humility, optimism, plus the willingness to dedicate real time.
Robos offer super easy entry, great for beginners, low or no minimums often, very few prerequisites beyond having some money to invest.
And finding the right human advisor requires that careful homework checking qualifications, ensuring a good personality fit, and critically verifying they are a fiduciary. More upfront effort in finding the right person.
Definitely.
It's also really important to stress, I think, that these aren't necessarily like mutually exclusive paths forever, right? It's not always strictly either.
Oh, absolutely not. The sources suggest you can definitely use a combination of these approaches, maybe at different stages of your financial life.
Can you give an example?
Sure. Maybe you start out with a low-cost Robo-Advisor just to get your core portfolio going, managed automatically, diversified, because you're new or just don't have time right now.
Okay.
Then maybe later, your situation gets more complex. You start a business, have kids, inherit money, get complicated stock options from work.
Right. Life happens.
Exactly. At that point, you might hire a human financial advisor, maybe on an hourly or per plan basis, specifically to help you navigate those complex one-off issues, get some targeted advice. But you might still keep your core investments humming along with the robo, or maybe even shift some to DIY as you gain confidence and knowledge.
So you can mix and match based on your needs at the time.
Totally flexible.
Ultimately, then, the best path among these 3. It's really subjective, isn't it? It's not about which one is objectively superior across the board.
Not at all. It depends entirely on your unique circumstances. Your personality, your comfort level with money and risk, the actual complexity of your financial life, and, honestly, your willingness and ability to dedicate time and effort if you're considering DIY.
What's perfect for one person could be completely wrong for their neighbor.
Exactly. There is absolutely no single right answer for everyone. But
understanding these options deeply, knowing the costs, what you get, recognizing your own strengths or limitations, knowing about fiduciary duty.
all of that knowledge empowers you to make a really well-informed, conscious decision about how you want to manage your money, how you want to build your financial future here in the U.S.
So we've taken this deep dive across the whole spectrum, haven't we?
Yeah.
From taking the reins yourself with DIY, demanding those key traits. Significant effort.
To leveraging the efficiency, the accessibility of automation with a Robo-Advisor, great for simplicity, lower costs.
And finally, seeking that comprehensive, personalized guidance from a human expert, especially for complex situations, but where verifying fiduciary duty is just absolutely essential.
And each path, as we've seen, has its own distinct advantages, its own disadvantages, when you look at cost, control, involvement, services, and that crucial human element, or lack thereof.
Knowing these options, really understanding the nuances from the discipline needed for DIY, the automation benefits of a robo, the different fee structures, and why fiduciary matters so much with humans.
Yeah.
That's fundamental, right?
Yeah.
To choosing the path that actually aligns with your goals and getting started on your wealth-building journey.
Couldn't have said it better myself.
And that leaves us with maybe a final provocative thought to chew on. Something that kind of emerged from that discussion around DIY and defining success.
Okay.
When it comes to building long-term wealth, is being a great investor really about consistently outperforming the market year after year, trying to beat the averages, pick the winners?
Which is something else.
Or maybe in today's world where low-cost diversification is so easy to get, is the true greatness found not in necessarily beating a benchmark, but simply in being a responsible, disciplined investor. Someone who consistently saves, keeps their costs low, sticks to a sensible long-term plan that fits their life, and crucially, avoids those big emotional mistakes.
Regardless of whether you choose the demanding DIY path, the automated robo route, or partner with a trusted fiduciary human advisor.
Exactly. Is that discipline and responsibility the real key to success? Something to mull over as you decide which path feels right for you and your own financial goals.